I'm a nerd, a geek, whatever you want to call me. Silicon Valley mentality. I'm a data scientist by profession, computer science, degree and education. And my passion, my obsession is to apply big data or big data analytics to anything, to everything. I apply it to growing tomatoes. I apply it to buying real estate. I apply it to new companies that I open. I apply it to my work day every day or every week. I track myself just like I would track a real estate project. So that's that level of nerdiness is what has caused people to call me the mad scientist of multifamily, and I think that label makes sense. Part of it is just life experience. I think that I've been very lucky in terms of applying data to lots of different things. My technology business, that I had a healthcare business, I applied data to both of those and worked beautifully. I was able to sell those businesses at class leading valuations. And then when I was doing that, because I was making a lot of money and I live in California, I was paying 50+% tax every year, federal and state. And so I started doing real estate, not with investors, just with my own money. And I used data to find a city called Madera, California, which is a very tiny city that I'd never heard of, 144 miles from the San Francisco Bay Area. And that application of data ironically turned out to be the most successful data bet of my career. Now, obviously, we have to exclude the last 5 years. We make big money when we buy these big buildings. But before I became a big syndicator with 800 investors, the biggest single success in my real estate career came from a data bet on a city called Madera, California. So the answer to your question is I'm big on data because every time I've used it correctly, I've seen shockingly large gains. So I'm going to take that question and divide it into chunks if you're okay with that, right?
Yeah.
So I don't have an honest answer for whether it's okay to get into the market or not okay to get into it. I'm just going to slice and dice it, and then hopefully I'll give you enough data to make that decision, right? So what we are seeing in the marketplace is that multifamily is different from single family. Multifamily is a business. Multifamily and single family is an emotion driven purchase. People buy single family homes because they want a single family home. They don't necessarily look at whether they're buying it for the right price or not. So we are seeing a diversion in the single family market versus the multifamily market since January. So since January, when interest rates started going up, the war started, inflation started to spike. Multifamily started to adjust within 3 to 4 months. Now, why did multifamily adjust? Because of lenders. There's only one reason. It's not because we are especially smart or smarter than everybody else. It's simply because of lenders. Lenders, over time, as they saw interest rates go up, started to reduce the amount of money that they would be willing to provide for a certain property because that property now obviously had higher debt service. And so as a result, we started to very slowly start seeing prices come down. So by April, it was less than 1%. By July, it was closer to 5 or 6%. Today, multifamily prices are down by about, at least by double digits. So there's obviously, when I say double digits, I mean across the board in the United States. There's parts of the US where they haven't declined by double digits. It might even be as little as 2 or 3%, and other parts where they've declined by 13 or 14%. But overall, looking at the United States, looking at some of the most popular markets in the US, we've seen a 10+% decline in prices. So if I had to peg a number, and this is not data driven, I'd say about a 13% decline. Now, home prices, because they're emotion driven, hold on for longer. And home price lender, or single family lenders, they take longer to adjust their worldview and reduce the amount of lending that they're going to provide for a home. So it's taking more time. Nationwide, the single family market's down about 2 or 3%, and we expect it to decline by double digits, so somewhere between 10 and 15%. And we expect the trough to be a year from now. So roughly 1 year from now, we expect the home prices will be 10 to 12% lower than they were at peak, with that peak being somewhere around January this year. That was the single family peak, we believe. So we might be off by a month or two on that. So bottom line is, you're seeing two different markets react to the same stimulus, and the stimulus is simply interest rates, right? So as interest rates go up, prices go down, and so we're seeing that adjustment happen. Now, I'm going to now, having set that groundwork, I'll come back to Vincent's question, right? What's Vincent saying? Is this a good time to buy, right? So if you're looking to buy single family or duplexes or triplexes, it is a horrible time to buy. Under no condition buy anything because the price adjustment of 12%, only 2% of that has happened. So for the next 12 months, it's a very, very bad idea to buy a single family, a duplex, a triplex, fourplex. Don't buy any of those things, right? Just wait, prices will come down. Now, on the multifamily side, the answer is more nuanced, okay? You are unquestionably today getting a 10 to 12% discount if you know how to do underwriting well. And the market is supporting that. Like there's still buyers who are like trying to sell their property for 5% less than January. Nobody's buying their properties. There are buyers that are selling for 10, 11, 12% less. People like me are buying their properties, right? Then there's a group that's like, yes, but the Fed, in the last month or so has said they're going to go all the way up to 4.75%. So prices must decline further. I completely agree with that group. I do not believe that you have seen today, we're recording this in October, we haven't seen the lowest price per door for multifamily yet. And I don't think that we're going to see the lowest price for another 7 or 8 months. Mortgage rates don't keep in exact lockstep with the Federal Reserve. So the Federal Reserve gives you forward-looking guidance, and that forward-looking guidance is what is used for mortgage rates. So the market has already priced in the next two Federal Reserve hikes. So the Fed meets in the first week of November, then they meet in the second week of December. Those two hikes are now inside the mortgage prices, right? So
Mm-hmm.
what happens if the Fed continues to raise beyond that point? Because they'll be at 4% for a Fed funds rate in December if they do what I think they are going to do. If they or 4.25, if they keep raising beyond that point, mortgages could go up even more. So the mortgage peak of the pricing could be December, or it could be Q1, could even be Q2. Who knows, right? It's hard to tell. So the prices for multifamily have declined by 10, 11, 12%. And prices for multifamily will continue to decline, in my opinion, for at least another 3 or 4 months. They could go down another 3 or 4 or 5%. So the question is this: what kind of person are you? Do you like to time the market? Is it a great thrill for you to say, I paid the lowest per door price during that dip? Because this is really a dip. As you know, multifamily fundamentals are extraordinarily strong. They are really the strongest I've seen them, and I've had a long career. They're very strong. So from apart from the fact that you're paying so much on the interest rate side, there's no reason not to buy multifamily. And I hope that anyone that is listening to the RE Social podcast knows that by now, that multifamily is a great buy. So your hesitation is really totally about the time frame. So you're buying the dip. You're already getting a 10, 11, 12% discount. The question is, should you wait for another 6 to 9 months and you might get another 3, 4, 5% discounts? I believe that while timing the market is something that we should attempt to do, the exact bottom, the exact trough is a complete unknown because there are forces far beyond real estate, such as the war in Ukraine, such as what's happening to shipping container costs, just such as what's happening to the prices of oil. All of these things affect that trough. So to time the trough is almost impossible. So to me, I'm buying again now. I didn't buy anything in the October last year to August this year timeframe because I knew prices would come down because I was seeing the interest rates go up. I knew prices had to come down. Now that I've gotten that 10, 11, 12% discount, I'm moving forward. But if you want to be an absolute timer of the market, and I don't suggest you do that, then I would say wait until Jan, Feb, March. You don't have to wait very long because we're only talking about 3, 4, 5, 6 months at the most to wait. Could possibly get 1 or 2 or 3% more off of that 10%, but
Mm-hmm.
I don't think the success or failure of this project in Orange County is going to be based on that last 2 or 3%.
Yeah.
So, be balanced about your investing opportunity. Obviously, I just want to give you a number. Today,
Mm.
I'm buying properties at $190,000 a door. Those properties cost about $50,000 a door 10 years ago. So they're still profit making, double digit profit making opportunities, even though they're almost 4x the price. So that last 1 or 2 or 3%, Vincent, is something that you shouldn't really chase after. That's my feedback.
Mm.
Obviously, if you waited 7 or 8 months for this property in Orange County, then you could get a bit more. I would say another 5 or 6%.
Mm-hmm.
Inflation in the US is still very high. It's reducing, but it's reducing very slowly. That means that over the next 7 months, while you could see a increase in cap rates, which affects the pricing negatively, you are going to see prices go down because of an increased cap rate. We are still continuing to see increase in rents. And the price of any multifamily property, whether it's a duplex or a 17 unit or a 200 unit, is dependent on two factors. One is the cap rate, and that's really the market sentiment. How much is the market willing to pay? And the second one is the rents, which basically affects your net operating income. So if cap rates are going to go up, well, they will have a downward impact on prices. But on the other side, if rents go up, they will have an upward impact on prices. So many people may wait 7 months and might still not see substantial declines in pricing from today because the property's rents over those 7 months have increased enough to offset the cap rate decompression. I don't like being academic with that definition. To me,
Mm-hmm.
the cap rate is what is the market willing to pay for a property, right?
Mm-hmm.
What is the percentage that the market is willing to accept if the market puts no debt on a property? So if it's a $10 million property, normally you put $7 million of debt on a property and you put $3 million of equity. But what if there was no debt available in the market? So you have to buy every property with 100% cash. What percent profit do you want to make on a property? So, for example, if a property is a four cap property, that means that if you buy it for $10 million, it'll make you $400,000 in cash flow. No debt at all. You're paying 100% equity, right? So, a cap rate is expressed in percentages and shows what the property would make if it had no debt. Why? Because debt varies. We've seen that in the last 12 months. So, debt's a variable. But if you set the debt aside, a cap rate is an excellent way to compare two properties. If there's two properties next to each other and one of them has a 4 cap and the other one has a 5 cap, well, the 5 cap property is a better buy. Why? Because if you don't apply debt, this property will give you 5% cash flow compared to the other one, which will give you 4%, right? So in times of interest rate hikes, cap rates tend to go up, right? Because people want to make more money from their properties because they can just leave the money in the bank. Today, people like me, I have a bank where I have 70 plus million dollars. That bank's giving me 2.9% interest, Comerica, right? 2.9% interest on my money. So if I'm going to make 2.9% risk less in a bank account, don't I want to make more money on my real estate? And that's why cap rates go up because my expectation of how much money I want to make goes up when compared to riskless investments. So we are seeing an increase in cap rates. Just so you know, when cap rates increase by, let's say, 20%, prices go down by 20%. But on the other side, you have to multiply cap rates by the net operating income, and the net operating income goes up if the rents go up. So there's this yin yang effect that's going on. But on the cap rate side, there's a downward pull on prices. On the rental side, there's an upward push on prices. And to some extent, these are balancing each other out, but still prices are falling. So it's a combination of two things. Number one, sentiment. The number two is while you do not factor in debt when calculating the price to pay for a property, the bank that is giving you a loan calculate has a different calculation called the debt service ratio or DCR or DSCR. Now, the bank absolutely looks at the total cash flow of the property, including the debt. And so, what's happening is banks are pulling back on the amount of money they're willing to lend on a property because they want the property to have a buffer. If the property has $100 in expenses per month, including debt, they don't want the property to have $100 of income. They want it to have $125 of income. So there's a buffer. This is called a debt service ratio of 1.25. So what's happening is as your interest rate is going up and your debt payment is going up, that 1.25 is becoming 1.2, 1.1, 1.05. So as that compression is happening, the bank's backing off and giving you a smaller loan. And that's really the predominant reason why prices are falling. They're not necessarily falling because people want to make more money off of the assets. That may happen in the future. But for now, they're falling because banks are not willing to lend as much money. The biggest thing that you can do and you should do is keep a significantly higher reserve and train your investors that the next 12 months is not a good time to get cash flow. This takes effort. It takes messaging. It takes time. Sitting down with investors and saying, look, right now, my first job when there's a recession coming up is to protect your principal, right? Multifamily is a great asset class. There's lots of upside, there's lots of room. And as what you have to educate them on is that every recession that happens in the future increases multifamily prices to our benefit, right? And I'll explain that in just a minute. So there's this dialogue that you need to be having with your investors so that they're not greedy for cash flow right now. Because if they're greedy for cash flow, you really are not going to buy the right kind of properties. So my messaging to my investors, and I'm building videos and things like that for my investors, is look, next 12 months, I'm just focused on getting through and paying this higher debt service. But the benefit I'm going to get from that debt service is as follows. And this is my belief, and you can just verbatim take what I'm telling people. When recessions happen, the first group that gets hit, and the group that gets hit the hardest, is single family home builders. So what happens is single family home builders build between a million and million and a half homes every year in the United States. When a recession, even before a recession starts, when interest rates start going up, those home builders, because they're selling the priciest product in the market on a per unit basis, they pull back because most of the single family homes in the US are 500,000 to a million. That's a very common range. And so now people are pulling back and saying, I don't want to go buy this house. I'll buy an existing house. I'll rent. And so we start seeing declines in the single family, building pipeline. We are currently seeing a 10% decline. I expect that to go to 20%. Now, what does that mean? And why is it so important for multifamily? Well, every year, if these guys don't build the number of units they're supposed to build, 1.5, 2 million units, let's say they build 150 to 200,000 units less because of all the stuff that's happening in the market this year. And then next year's a recession year, so that's another 150,000 less. 300,000 homes that would have been built are not built. That 300,000 home supply hole is basically fulfilled by rents going up, on the multifamily side. So the beautiful thing about every recession is that it actually increases rents when the economy comes out of recession. And that is why rents are such a big part of inflation today, right? This is extremely important to understand that, in fact, by having high interest rates today, we're almost creating a guarantee of having high rent growth 2 years from today. The vast majority of investors have an overinflated and entirely untrue opinion of their investing capabilities. So if you look at the stock market returns over the last, let's call it the 50 years, it's about 6%. So you might say, does this 6% apply to me? Of course, I can do better than 6%. Well, on average, 6% is what the entire stock market makes. Individual investors make 4.5%. 4.5% is what all of you guys that are individual investors in the stock market are making. It's the barns that are doing better. It's the funds that are doing better. Individual investors do extremely poorly when picking stocks. So you're making 4.5% as a group. But the problem is every investor, single investor, is so egoistic that they think that they are that one person that is going to do better than that 4.5% number. And they're very commonly wrong. And the big reason for that is time. When you're working a full-time job, let's say you're working 10 hours a day, as a technologist or as a doctor, The amount of time that you can spend researching, making offers, buying properties, managing properties, selling them, fighting adverse, events such as COVID is extremely limited. Only the most egoistic investor would think that in, let's say, half an hour a day, which is all you've got, you can outperform other people that spend 10 hours a day doing something. You wouldn't think that if you're digging a trench, that you can dig a deeper trench in half an hour than other people can dig in 10 hours. When you're working at Google, you wouldn't think that somebody working at Google for 30 minutes is going to achieve more than you're achieving in 10 hours. Then why would you think that someone who is a full-time experienced investor with a track record is not going to outperform you? The truth is, seen as an average, they're going to outperform you all the time. And what essentially is happening is that you're giving your money to somebody that is outperforming you by such a wide margin. You're at 4.5%. If you stick your money in the stock market, you might make 15, 16 IRR, internal rate of return. If you give your money to somebody, like me, my IRR is 35.3% from all of my exits, and I've had a lot of exits. Bottom line is, that's the difference. If you're going to go from 4.5% to 35 IRR, you made 30% more, even though I've made a lot of money, which is not included in that 35% IRR. So any investor, if they believe that they're data driven, all they have to look at is, what does a typical investor make in the stock market? And you could say, well, I can buy real estate as well. So look at what typical investors have made in real estate, individual investors, and it's very disappointing, right? Now look at what 100 syndicators together. I'm not talking about me. I'm not talking about Vincent. 100 syndicators together. How much money have they made? The math is so ridiculously simple that under no condition are individual investors anywhere close to our net returns after our splits, after our fees. We're still far beyond where individual investors are. That's just the truth. And I challenge anyone who wants to take me up to it, send me an email and let's sit down and walk through these numbers. I think what the right answer is to do both. So I currently
Yeah.
have 26 passive syndications. I'm not involved in these syndications because I feel like I'm good at multifamily, I'm good at built to rent, but I'm not good at industrial, even though I've done industrial syndication myself and they've made really good money. I've done self storage myself and they've made really good money, but I don't consider myself to be an expert. I am a dabbler in these areas. So now I'm giving other people money in their self-storage syndications, their industrial syndications, their syndications for student housing and many other asset classes where I feel like I just don't know enough to ever make what these people can make. And I continue doing that, and that number is actually going up. A year ago it was 20, now I have 26 of them. I even invest in legal syndications. You don't even know what that is. It's a syndication where I provide money to a company that lends money to lawyers that are suing, and they become partnered with them. And if the lawyer wins the lawsuit, then basically I make a bunch of money. If the lawyer loses the lawsuit, I lose money. So I invest in those kinds of funds, right? Because there are companies that are experts at figuring out the chances of each lawyer to win a lawsuit. How am I ever going to learn that? But I am making 30% IRR today using someone else's skill. Investing is a mindset. What will make you successful is not the money you have, but the mindset that you have. Let's say you're working at McDonald's and making 16 bucks an hour. Allocate 10% of that. That's $1.60. And you might say $1.60 is not a lot of money. It is. Trust me, your $1.60 is the same as someone who makes $160 an hour, even though you're only making 16, because it's training and mindset that creates success. Every person who is at McDonald's who is willing to take 10% of their McDonald's salary and put it into investing is going to be successful. All of them, 100% of them. It's only a matter of time because they have the mindset. And all of those people that make $160 an hour working at Google that do not invest are not going to be successful. Success means not having to work for your livelihood. And that Google person is working harder than most people work at McDonald's. and they'll always be working harder unless they create an investing mindset. So, in my opinion, and I'm not being biased about this, I'm just being very candid, the McDonald person has the exact same chance of being successful and rich as the person at Google as long as they have the same mindset. And what's cool is a lot of people that work in high end IT jobs have a terrible investing mindset. Train your mindset. The number of dollars is not relevant. Take this on faith. As long as you're investing 10% of your income, you're fine. Even if 10% is a dollar 60. Many places that you can go out and invest in. So I'll give you some examples. There's a company called Fundrise that accepts money in
Mm-hmm.
small tranches, $100 or $1,000.
Mm-hmm.
You can go to arrivedhomes.com and they will take $100 of your money. They basically buy homes, and so it's single family homes, so you're buying a share in that. There's also here.co, that's HERE.co, that allows you to invest into Airbnb. So they buy $1 million Airbnb property, they sell $100 share. You can invest in those Airbnb properties with them. They offer cash flow. Remember, the amounts are not relevant at all. It's the investing mindset. So if you have $100 to invest, invest in Arrived Homes, invest in here.co. Someday, because of that investing mindset, you'll have 10,000 or 50,000, and then you're going to invest that 50,000 with Vincent Rodriguez, because I think what Vincent does is actually more powerful than what Arrived Homes does. Arrived's kind of sitting on homes, but you're going to get started that way. And over time, you'll make better investments. Private syndicators bust their asses on making their investors money. I spend, sleepless nights when I have a property that's at risk. I don't think Arrived would be willing to do that, but it's a great place to start to get your mindset going. There's lots and lots of places today. You're so lucky have the option to invest in here.co, lofty.ai, arrivedhomes.com, fundrise.com. These are all options to get you started. And yes, the returns are probably not as high as what Vincent Rodriguez or Neal Bawa would offer, but it doesn't matter because you're getting started. Neal Bawa has 31 projects running, so he's not going to offer as much focus as someone that has a third project or fourth project running. In my opinion, and I feel sorry saying this, but I'm just going to be candid. You probably don't want to invest with somebody that's doing it for the first or the second time, right?
Mm-hmm.
But by the time somebody does syndication for the third time, they've learned a lot. They've learned a lot. And you're going to leverage that knowledge in your third investment. And they're probably going to spend more time on that investment that Neal Bawa can spend on it, because Neal's got 31 of them. The SDR market is bubbly. There's a lot of, the prices are pretty high in that particular market. I think that
Mm-hmm.
it's a terrific long-term market. I think that there's a change happening. More and more young people are comfortable with short-term rentals and Airbnbs. I can tell you personally for myself, I spend over $20,000 a year on Airbnb, over $20,000 a year consistently every year. I've lived in some of the most beautiful Airbnbs featured by the company itself. I'm going to 4 Airbnbs in December. So Singapore, Phuket, Pattaya, and Bangkok. I
Mm-hmm.
rarely ever live in hotels. I think Airbnb is a much better deal than a hotel is. You get a lot more for your money. And I think that as time goes on over the next 10 years, people will see that. You will start to see more of that, evidence of that. And I think the short-term rentals area will continue to grow. Having said that, my forecast is home prices are going to drop by 10 to 15%. And I see no evidence that somehow the Airbnb short-term rental industry is going to avoid that 15% price drop. I think that they will have just as much of a price drop. So I do think that there's an opportunity to wait until the end of that price drop at this point instead of being in a hurry. Buy a multifamily. As I said, with multifamily, you've already seen a 10 to 13% price adjustment since the peak, which could have been Q4 of last year, Q1 of this year, depending upon the market. So you've already seen a deal, you've already seen a dip, right? 10 to 13% is a significant dip, and we don't think that the next dip is that much, maybe 5% more. if you don't want to wait, buy multifamily. I think that this is a good time to buy multifamily. I think it's a bad time to buy single family for the next 6 to 9 months because the single family market always takes more time to adjust. I started doing, real estate in 2008. We're in 2012, 22, so we're talking about a 14-year journey. But I think the key part of the journey was that place in Madeira. So in 2008, prices were crashing. I didn't want to get killed. So I hired a Ukrainian hacker to spider the Zillow website and also the Bureau of Labor Statistics website to try and find the market in the United States that had the biggest fall from the 2005 peaks. So from 2005 peaks to December 2008 trough, what was that biggest gap? We looked at 400 markets, we sorted them out, and the market that had the biggest drop, which was a shocking 70% from peak, was Madera, California. So I basically went in, bought a bunch of properties there, 10. Then I bought a bunch for my sister-in-law, my mother-in-law, bought, friends. I bought a bunch of properties there. They all did phenomenally well because the math made sense. Because I was buying properties at basically I was buying them at 40% of the cost of replacement. I knew that I would make a lot of money if I was patient enough. So, and I had to do a bunch of things. There were no renters, so I had to use teams in the Philippines to rent them up, to offer Fresno, tenants who were 25 miles away to come to Madeira, which was, and a lot of them didn't want to come, so I would give them, Amazon gift cards. I would give them discounts. I would give them free month or 2 months just to get my properties rented. So my initial hustle was documented by me in a series of webinars that I did in the San Francisco Bay Area. And then I decided to develop that into a system. I said, how do I find the best cities in the US? That turned into something known as location magic. If you Google my name, Neal Bawa Location Magic, you'll see it. It's a simple system that in 10 minutes allows you to compare any city with any other city in the US. And I started giving it away through meetups in the San Francisco Bay Area. Then people started calling me on Zoom and other services, then to conferences. So by the time I had sold my technology company many years later, we're talking 6 years, I already had a huge database, a massive database of people that were following what I was doing. And so I was able to transition much quicker than most people and also get significantly larger number of investors. So at last count, we've had 260 million in equity invested in our projects. I haven't used equity raiser, so all of that money comes directly from my database. And 260 million basically equates to $1 billion when you're doing new construction. So Location Magic is free. It has no pro version. It has no subscription. Each year in January, we update it and we give it away for free. It's available at multifamilyu.com. That's multifamily followed by the letter u.com. Go in there and there's a course. It's an hour long. You can also Google it. You just Google Neal Bawa Location Magic and take it. It's free and it's always meant to be free. It's the same system that we use internally. So you've got Neal Bawa sitting on your shoulder when you use it. We do about 20 webinars a year. 30,000 people attend these webinars. And these webinars basically talk about our beliefs. For example, I have a webinar coming up. I'm going to be talking about a disruptive technology called crystal lagoons. I don't even have a crystal lagoons project, but I'm talking about it because I know it's disruptive. And hopefully some of the people listening get their hands on a crystal lagoons project. So that webinar, I think, is on the 20th of October. So come check that out. We talk about anything interesting and disruptive, regardless of whether we have any role to play in it or not. So if you're interested in that kind of learning, join multifamilyu.com.